As we continue talking about cost, volume, and profit analysis, break even is a very, very powerful concept. Let me give you a quick story. A colleague of mine was invited to be an interim CEO for a company outside of Madison, Wisconsin. And they needed a CFO because they had a bookkeeper, but they had lost their controller and their chief financial officer. And they said, Scott, he asked me if I can come on board for a short time, part-time, to get things organized and under control. Said happy to do so. Came on board half-time, and first problem was the balance sheet was out of balance. Not a good thing. We corrected that pretty quick. But the second question was they were losing money. As they were losing money, they said, well, at what point do we need to get to that we're actually making money? And there's a concept called the break-even point. And I basically, in about 10 minutes, did a quick back of the napkin analysis and was able to say, you know what, if we reach this monthly sales volume, this is where we break even. And within 60 days, we reached that monthly sales volume. Sure enough, we broke even. Basically, break-even analysis is about covering your fixed costs and then ultimately shooting to make a profit going beyond the break-even. So let's talk a little bit more about that and how do we calculate this break-even stuff? Pretty powerful. So if we look at break-even analysis, and we've looked at these formulas before, we know that when we have our price times the number of units, that's what our sales revenue is. And then we have our fixed cost and variable cost, our fixed cost A and our variable cost B times the number of units. So if we want to calculate our break-even unit sales volume, that's when our profits equal zero or our sales equals our costs. That's our break-even point. And if we can do that, we can say, oh, I could take fixed costs, I rearrange that formula, and fixed cost equals sales divided sales minus variable costs. So we can do this on a per unit basis, which we're going to do here. We take our selling price per unit and our variable cost per unit. And if we go ahead and break out a little further, I'm actually going to change the screen and we're going to go to a whiteboard and take a look at an example of how we might handle this. So if I went and told you my selling price is $10 a unit, and then I said my variable costs were $5 per unit. And you would very quickly tell me, oh, I remember this contribution margin thing. My contribution margin per unit is $5. Okay. And I say, well, for every unit I sell, I make $5. But wait a minute, I might have fixed costs. And let's look at fixed costs. Say I have fixed costs of $10,000. How much do I make if I sell one unit? Well, frankly, I take my sales of 10 minus my variable cost of 5. I got 5 in profit, and I have 10,000 in fixed cost. I'm still running a loss of $9,995. If I sell 2 units, I'm running a loss of $9,990. Well, how do we get to the point of break even? Well, if I take my fixed costs divided by my contribution margin per unit, well, in this case, we had $10,000, and I divided it by $5 per unit. That's going to give us the number of units that we have to sell to break even. So dollars divided by dollars per units equals units. So what's 10,000 divided by 5? I got 2,000 units to sell. Let's see if that actually works. I go 2,000 units, and I go 2,000 times $10 units. That's $20,000 in revenue. And I subtract my variable cost, which is $5 per unit times 2,000 units is 10,000, minus my fixed cost of 10,000. You don't have to look far and fast and use a calculator to figure out, hey, I didn't make any money. Oh, if I didn't make any money, that's not bad or good. It's just I break even. No profit, no loss. I'm exactly break even. So let's go back to our formulas and take a look at our formula here. Again, we have fixed cost over selling price per unit divided by variable cost per unit. Okay. So if we look at that, we're going to actually get a dollar amount And we're going to look at far below break even, companies at a loss, and if we're above break even, we're at profit. So what the heck does that mean? So let's take a look at our ice cream book bars that we're making. $1.10 a unit variable costs. They sold for $1.50 each. Fixed costs are $17.80. So here we go, similar idea. We have our fixed cost in the numerator. We have our unit contribution margin, which is our selling price minus our variable costs. That's our contribution margin. Gives us the number of units to break even. So if we sell 4,450 ice cream bars per month, we will break even. That's no profit. Eventually, we'll see that we can add the profit we want to the numerator. We have fixed costs plus profit desired, and then we'll come up with how many more units we need to sell based on, in this case, 40 cents per unit contribution. So this is the next part of that. We have that desired profit. Let's say we know our fixed cost is $17.80. We know our contribution margin is still 40 cents per unit, but how many additional units do we need to sell to get another $800? Well, we need to divide that 800 by the 40, and we add that together, get the total of the 6,450 units that we need to be at. Let's look at it graphically. That bottom green line is a variable cost. If we make 0 units, we have 0 variable costs. The red line is a total cost. We add to that this fixed cost, which starts at the 4,000, and we progress upwards, and we add to that, we have a total cost line, which is our variable cost and our fixed costs. And then we have our break-even point, which is where our costs equal our revenues. And if we go beyond that, we're in profit territory. If we're below that, we're still in loss territory. The one additional line I would like to draw here is a line across this 4,000. We have a fixed cost line across the board, starting at this 4,000. As you can see, that's where the red line starts with 0 units. So if we look down here a little more focused in, we'll zoom in, and we'll see that our break-even point is going to be where our intersection of our total cost line intersects, and we establish our break-even point where our total costs equal our total revenues. That's 0 profit. That's why it's called break-even. And then we have a contribution margin income statement. We've got our sales less our variable costs to get to contribution margin. Similar to gross profit, but our cost of goods sold does often include fixed costs as well. We're isolating the fixed costs in our contribution margin, our CVP income statement. Our contribution margin, we'll do similar percentages eventually, but we have our fixed costs, in this case, fixed manufacturing overhead, fixed selling and administrative, before tax profit, and then we do have to account for income taxes. That's state and federal here in the States. And we have an after-tax profit that goes with that. So that gives us a little bit better picture of what break-even analysis looks like. So I'm going to go ahead and cut off here, let this penetrate, let this sink in for a little bit. And when we dive back in, we'll continue further and finish off the module. Thank you.